the IMF thinks that in the US inflation will rise to 4% CPI, but core inflation won't go above 3%. What? Yeah, this is, I think this is a measure, if you like, of where intellectually, the sort of the investment banks, the strategists, the investment strategists and the economists, all that's where they are at the moment. And they're having to rethink this. And the consequences obviously are very, very negative for currencies, because what we're talking about, what is inflation? If you're talking about inflation of prices, actually, it's loss of purchasing power of the currency. And it's that people, foreigners initially, will be looking for recompense for. If you're going to continue to hold dollars and its purchasing power is going down, then you're going to need a higher yield on your bonds or your deposits, or better returns on your equities, or whatever it is. Without that, you sell the currency down. But the problem is, what do you sell it for? Because all other currencies, all the G7 currencies anyway, are in the same boat.
This massive currency sell-off guarantees a terrifying reality. The era of the everything bubble is officially over. While the US stock market currently appears stable, international equities are already beginning to crash, signaling a devastating global financial contagion.
So you've got this sort of slightly unreal situation where everything is crashing except markets. But that will come, and I think that's going to happen, I think, in the coming weeks. I mean, you've already seen, for example, look at the Japanese stock market. That definitely is on the way down. I mean, you could argue how far down it'll go. That's not the point. But the point is that it's lost its upward momentum, and once it's lost its upward momentum, we're talking about the very minimum a fairly significant correction. Other markets will follow, because Japan is the major exporter of capital to G7 nations, including America. I mean, in two ways. First of all, directly through its insurance companies and pension funds investing for higher returns. And also because the Bank of Japan suppresses interest rates. Their reference rate at the moment is 0.75%. And that's the highest it's been for 30 years. The carry trade on the back of this is enormous. It's just built up and built up and built up over time. So what we're looking at is Japan actually is sort of pulling the blanket up, like that, out of the whole system. And the whole system is going to collapse, in effect. That's the risk. And I don't see anyone really understanding this. Consequences. And so what, I just asked a question, what currency do you get out of? Do you go into? Well, I mean, there's only one answer for that, and that is that as a foreign investor, foreign holder, whatever, of, say, US assets or British assets or whatever, you go back to your own currency. Because that for you is your risk-free position. Because you account in your own currency. If you see what I mean. The only other thing is that the value of these currencies will be reflected in their exchange rate with real legal money, which is only gold. Silver maybe as well, but particularly gold. And I think that what we've seen is we have seen the banks, the big investment banks, have actually realized this, though they won't admit it, are moving in that direction. I mean, they're making forecasts for gold, Goldman Sachs saying $5,500 at the end of this year. I mean, that's like saying Goldman Sachs is saying it's going up. I mean, they don't produce forecasts like, we think it's going to go to $10,000. They don't say things like that. I mean, don't accept any forecast as being the truth, if you like, in terms of what the forecaster actually thinks. But the fact that all these banks, and indeed at the last LBMA meeting, I think it was in Korea, in Octoberish, September, I can't remember. Anyway, last year, again, the consensus was for higher gold prices. The establishment knows that gold price is going up. They don't necessarily understand that it's because the dollar is going down and gold is relatively stable. It's the dollar that's going down. It's other currencies going down. But they know in which direction this is going.
Because the smartest money knows the paper market is a trap, they are completely abandoning derivative contracts. The open interest for gold and silver on the COMEX just hit multi-decade lows, signaling a historic, permanent exodus from the rigged paper system.
So what we've seen on COMEX is we have seen open interest in gold fall. And it's fallen to the lowest level for over 15 years. It's something like 390, no, 300, I think it's got down to 368,000 contracts. This is the lowest level for 15 years. Silver is already at the lowest level in terms of open interest on COMEX, the lowest level for over 20 years. In other words, this is the system getting out of paper. Silver is a huge, great problem because everybody's short of the stuff. And they can't really get out of it, say. Gold, in theory anyway, is slightly less of a problem because while they're short on COMEX, they're long in London. At least that's always the assumption. And I think that was probably the assumption. I think that's probably true when, the LBMA's straw poll came up with forecasts, above the then price. In other words, everybody was basically net long across the market. But China is sucking gold out of the world. It really is. I mean, the banks are finding huge retail demand, which is continuing, despite the markdown in prices. I mean, I think the markdown in prices was, if you like, some sort of combined attempt to try and really shake out the bullishness out of the system. But China is a huge, huge saver. And I mean, I think coming back to your point, the thing that's changed for me is that this Iran war and the mess that the Americans and Israelis are making of this, and in Israel's case, the mess they're making of themselves, basically tells me that the end of the fiat currency system is being hurried along. It's going to happen a lot sooner than we might otherwise have thought. Yeah, I think there's a sort of fair point. I mean, the underlying point is that there is plenty of oil around. And in time, we can adjust, if you like, to the shutting of Hormuz and potentially also the shutting of Bab el-Mandab, the entrance to the Red Sea, which I'm pretty sure that the Houthis will do. But the real problem is that the shortage, there's a shortage which, until you get that reallocation, as it were, if we get that reallocation, there is a shortage of energy. It's simple. And, we're not just talking oil. We're also talking LNG. We're also talking about bunker fuel, which is, stuck in the Gulf, and therefore that's affecting, shipping. Most importantly, we're looking at, downstream, products out of oil, fertilizers, sulfur, all that sort of stuff. Helium, people are focusing on helium, for example. These are real. I mean, I was listening to a professor of economics who sort of specializes in oil and derivatives and all the rest of it. And he said he tells his students that some 45,000 products depend on oil. It is part of our everyday life. It really is. So the price, if you like, is the secondary problem. The real problem is the supply of all those things which we need. And, particularly, sort of urea and phosphates and all the rest of it at the beginning of the Northern Hemisphere's growing season. I mean, if you haven't got the fertilizer, you're not going to have the food. What's that going to do to your CPI? What's that going to do to the IMS forecast of the CPI? Oh, don't worry, core inflation will only be 3% at the end of the year. It's obviously nonsense. So I think that's the key thing. I don't know where oil prices are going to go. I mean, some people say, oh, it's going to go to 150, it's going to go to 200, whatever. I suppose it will, but I don't think it's because of the Gulf. It's because the purchasing power of fiat currencies is going to collapse under a weight of debt. We can already see that measured in gold, oil is cheap compared with its long-term value in gold. I reckon that if you look at the long-term chart of oil priced in gold, I reckon that it's priced at it's now less than 30% of where it should be on long-term value, and that implies that the price measured in dollars should rise to somewhere like $300, and that's without the dollar going down. So, it's not just oil. Commodities as a whole are in the same thing. And if I look at a basket of base metals, I get exactly the same story. In that case, you're looking at about 25% where it should be. In other words, it should quadruple from current levels. That basket should quadruple from current levels.
This guaranteed commodity shock will absolutely break the global bond market. As inflation spirals out of control and interest rates violently rise, the entire foundation of Western finance will fracture. Macleod warns that investors must immediately abandon the massive credit bubble.
I mean, you look at something like copper, for example. Copper, the price rises and rises and rises. There's plenty of copper around. But of course, what people don't see is that the reason the price of copper is rising is because the value of the currency as you measure it in is going down. And, it's a difficult concept for people to understand. And the people who understand it least are the people working in the investment industry. They really don't understand it. Why? Because they account in dollars. Their performance is in dollars if they're American. So for them, that trumps everything else. They're just not interested in the idea that the copper price is rising because the dollar's value is falling. It doesn't occur to them. Well, the consequence is really, we can sort of summarize it by saying that basically it's collapsing the value of credit. And the answer is get out of credit and get into real money, which is only gold. I mean, you can get into other real things, farmland maybe. I wouldn't get into real things which are leveraged, like residential property, because initially that will go down. We're seeing the end of the fiat currency system, Alexei, and what that basically means is that the value of our fiat currencies, so long as they remain fiat, will go to zero. And where does that put the price of gold? Well, if you're an investment manager and you don't understand what the hell's going on, infinity. So, that is the big picture. This is the end of the fiat currency system. I thought we might have several years left in it because it should be not an orderly decline, but I mean, you could see that you would get maybe shocks and then, there would be a response, kick the can down the road a bit sort of thing. But this, war against Iran was a huge, huge mistake. I mean, it really was. I even came across someone the other day who told me that they were buying Chinese yuan because they understand the point that I've been making, and that is that the Chinese have put in place the means of protecting their own currency. They could go on to gold standard tomorrow, certainly for the international yuan rather than the domestic yuan. Russia is exactly the same, and they will do that to protect their own currencies. They won't do it before it's necessary, because otherwise they'd be accused of undermining the Western system, and that would be World War III stuff. So I think they're likely to just see things really start sliding amongst the G7 nations, led by the dollar, and then they will protect themselves. And they've put everything in place. I mean, you've got vaulting facilities in Saudi Arabia, which will cover the whole of the Middle East, which will all go Persian, Iranian, on behalf of China and Russia. Well, yeah, I mean, basically, I don't see that Dubai, Abu Dhabi, wherever, are really being very much a storage center. What they are is a big market, yes. And stuff goes on to India in particular. So, excuse me. I think that's the way to look at it. You've got a lot of bears, gold bears rather than bulls, trying to sort of make up negative stories, saying, they want to sell their gold because, they need the funds. I mean, what a load of rubbish. They've got dollars coming out of their ears. They've got plenty of dollars to sell. It just doesn't, there is a small element, if you like, of, okay, you've got market disruption in physical gold. Of course you have. But which way is that going? It's not a slam dunk. I mean, do locals say, here's some dollars for some gold? Or do they say, here's some gold for some dollars? Well, the answer is they've already got dollars. They don't actually need to rush out and liquidate their real money in order to survive. I mean, there may be some in that position, but I think that's a tiny minority, really. There is a disruption, if you like, in the distribution of gold. Yeah, of course. But the idea that this is producing sellers, I think is a myth. I really do. I wouldn't buy that at all.